So, excuse me, we're here, November the 30th. As you know, since this has been going on since last week, Tuesday, the test 2 and quiz 2 are having a final due date today at 6 o'clock. So if you haven't started yet, you absolutely need to get going on that, because 6 o'clock is a hard deadline for you to be done with the work. Everything will auto submit at that point. And if you haven't done anything, whatever is saved, up to that, not if you haven't done whatever you've done up to that point, whatever's saved and not submitted will be your submission for the test and the quiz. All right, so please get that done if you haven't started, for whatever reason. Remember last time when we were together, I was going over the chapter 17 homework and it took a very long time. So I discussed a little bit about chapter 18, but today we'll go full force into chapter 18 and we'll also be busy with it on Thursday. My hope is that for next week, Tuesday, which is the last day of class, that we'll be able to do some reviewing. I'll probably base it off of the final exam review that's in Wiley Plans. All right. So we literally only have 3 meetings together today, and then the Thursday and next week Tuesday. The last day to withdraw from any class, sorry that this is cut off, but I think you guys know this already, is Wednesday, December the 8th, which is also the last day of classes at the college. The 9th is reading day. I'm opening the final exam on the 9th. You can take it anytime between the 9th of December and the 14th of December. It will close that Tuesday at 6 o'clock. All right. And then the last date that you want to take note of is that the chapter 18 homework is due on December the 7th, which is the last day that we'll see each other. All right. And I'll go over, at that point, I'll go over everything that's going to be on the final exam and so on. That information's already here. I just want to show you, although it's not the top item, but it's always been here. All right. It's always been on the test and quiz information sheet, and it's already there, but I'll go over it in detail with you guys, and we'll go over some review questions and just generally try to make that last session that we have together as useful as possible. All right. Yeah, so let me see, someone asked me a question here. Oh yeah, the chapter 17 grade, it's my fault because she's saying she doesn't have a grade for chapter 17. The written piece that I went over, remember I went over that whole long thing with you guys about what's the impact on the cash flow of these transactions. I have to go through and grade every one of those. And unfortunately, over the Thanksgiving break, I had to grade term papers for my accounting capstone course. So the chapter 17 homework wasn't high on my priority list. I'll probably get to it later this week, but it's something that I haven't looked at, because I know that in the test I knew that in the test there's no written parts in the test. So even though you don't have the grade for that one question, it's not really going to impact your test. You should be able to see what you got for what grade you got for the other questions. All right. So unfortunately, I had another set of priorities that I had to take care of over the break. So thanks, lady, for reminding me again to do that. But I'll have to see when I can actually get to it, because I still have a few things that I need to do for the other class today. So maybe tomorrow. All right. If you have a concern, lady, about the homework for some reason, remember I went over the entire homework in the previous session. If you have some type of concern about it, you can speak to me during the break. Any other questions about the calendar or anything like that? All right. So I will move into the chapter 18 work. All right. So remember I said that chapter 18 is all about financial statement analysis, and that we will focus our efforts on ratio analysis. I showed you the horizontal and vertical analysis when we started the chapter, but my concern for you is with these three categories of ratio analysis, specifically liquidity, profitability, and solvency. Okay, those are the major categories in which these ratios fall. And again, a ratio is just an expression of one number in relation to another. It could end up being a percentage, it could be a proportion, it could be expressed in different ways. So we'll see as we calculate these ratios how they are expressed. But I guess the point is that you're doing a calculation based on a formula that is given to you, but you actually need to understand what the answer means. I think that's probably the most important part about all of this, that it's important to know what the result is actually telling you. Okay, so we'll start just in a few minutes with liquidity ratios. When we start with that, we'll see that there are a number of ratios within this category, and this is all about whether the company will be able to pay their liabilities in the short term. Okay, that's the liquidity ratios are all about, in the short term, do you have enough current assets to cover your current liabilities? What's going on with your cash, your ability to pay off your creditors. Profitability, are you able to generate profits? Do you have a net income or a net loss? Or is there a return, a good return on equity for the people who are investing in the company, and so on and so forth, right? So it's the operating success or the profitability of the company over time. And then solvency is, will you actually be able to survive, right? Are your total assets greater than your total liabilities, or are you owing long-term creditors so much money that you actually are what we call insolvent, meaning that your liabilities are bigger than your assets? So those are three major categories that the ratios that we will do fall under. And all of those categories are important. From time to time in this class, we've spoken about from time to time, we've spoken about investing in companies and all kinds of stuff. So all of these types of things are also used to see how companies are doing. And I had mentioned before, so I'll just refresh our memories, right? You can look within the company, so intra-company, year over year, how is the company doing? 2021 versus 2020 versus 2019, obviously then taking into consideration things that have changed over time. You can also compare the company to the industry if they do fit well into a known industry and their industry averages. So how's the company doing in relation to the industry? And then you can also do inter-company, and there's an example in the textbook where we do the ratios for Target versus Walmart. And that's an intercompany. Even though Walmart has much bigger numbers than Target, it doesn't necessarily mean that Walmart is doing better than Target in terms of liquidity, profitability, and solvency, right? We don't look at whole numbers, we look at the ratio calculations. And as we go along, we will learn how to do these calculations. And just so you don't panic, you don't have to memorize these formulas. Like even if we were in class and you were doing the test or whatever in class, I would give you a formula sheet. I'm more concerned with whether you know how to apply the formula and what the answer is telling you about the company. All right. And as I said before, there are three tools of analysis that the book gives us. One is horizontal. Again, you can look through the book. I'm not going to test you on this, but they're just looking at percentage changes in numbers year over year. So, revenue in 2020 versus 2021, by what percentage has it increased or decreased? Vertical analysis, you're expressing one number as a percentage of another number. So you might say, what is expenses as a percentage of total revenue, something like that. But our focus again is ratio analysis, okay? The relationship between different numbers on the financial statements. So I'll just give you a minute to process that information and see if you have any questions for me. All right, so we're good. I don't see any questions or anybody saying anything. Okay, so let's get into it. A ratio is a mathematical relationship, right, between one quantity and another. It's a percentage, a rate, or some proportion, and the ratios can be used to evaluate those three different categories for the company. How liquid is the company, right? So how much, I guess, cash or cash equivalents do they have on hand to pay their liabilities? How profitable is the company? Are they able to generate a lot of profits from their business? And then how solvent are they? Are their total assets much bigger than their total liabilities? So starting with liquidity, the first ratio that we hit is the current ratio, right? Current ratio, very popular ratio. It's, it comes up a lot. So let's see what it says. Evaluates the company's liquidity and short-term debt paying ability, shows the amount of current assets the company has for every dollar of current liabilities, right? So remember, current assets are the assets where you expect to get the future benefits within 1 year from the balance sheet date. So we're talking about cash. We're talking about accounts receivable, right? We're talking about inventory. We're talking about prepaid expenses. Remember these things from when we were doing the cash flow? We had to know which items were current assets. And then current liabilities, you're talking about accounts payable, accrued expenses payable, interest payable, right? All those payables that are going to be settled within 1 year from the balance sheet date. And so the current ratio is current assets divided by current liabilities. And there's also another calculation that people sometimes do when they want to buy a company to see truly how much, they call it working capital, like what money do I have to work with? You say current assets minus current liabilities, and the number that you get, as the answer is the amount of capital, meaning money, that is available to be used in different ways. All right, so those are all current ratio. What we'll do is I'll go over these ratios, in the abstract here, explaining the formulas, and then we'll immediately go into an example that is calculating, some of the ratios. So just sit tight. The next ratio is called the quick ratio. Sometimes I don't know, it might be a bit old-fashioned, but some books will still say the acid test ratio, but quick ratio is kind of more a more popular name. It's again a measure of the company's short-term liquidity, and it does go with the current ratio. So, what's the difference, you should say? Well, with a quick ratio, you leave out inventory. Okay, so you really are only going with cash, any short-term investments, and any accounts receivable minus any, bad debts, allowance for doubtful accounts. And the reason they do that is they're trying to see, if you take out the inventory that the company is carrying, which obviously is going to take a while to sell the inventory and so on, right, before you can actually get the cash from that inventory. If they had to pay their liabilities right now, okay, they obviously cash can be used, short-term investments can be sold almost immediately, and then the accounts receivable could be a word we call factored is you can actually sell your accounts receivable off to a company that will give you, let's say your accounts receivable $100, they'll say maybe we'll give you $90, and then they try to collect the full $100 so they can make a $10 profit. So that's called factoring. So what's happening with a quick ratio is that we just want to see, okay, let's ignore inventory that might take a long while to sell. For everything that could be turned into cash quickly, can we still pay our debts, right? Our current liabilities. And it's not written here, and I'm not sure that the book goes into this, but we normally, right, I'm saying normally look for a 2-to-1 ratio, okay? And here we normally look for at least 1-to-1. What this is saying is over here, the 2-to-1 means for every $2 of current assets, or for every $1 of current liabilities, let me put it that way, I have $2 of current assets, so I can cover my liabilities 2 times over, right? That's normally the type of ratio we look for as an indicator that the company is doing okay. And here, because we've removed inventory, we're okay with a 1-to-1, right? For every $1 of current liabilities, I have at least, I mean, it depends on, you ask me if I'll upload the document with the changes. It's literally just a sentence. So I'm not sure that I'll re-upload the document. If you could take a note, that would be great. I'm not sure that I'll be able to upload this just for this change. What I'll do is maybe go through, if I'm making changes, I'll mark them in yellow. And if there's a lot of changes, then I'll upload, but I don't anticipate really writing a lot of stuff on the document, right? So maybe just take your own notes. I don't want to be, say that I'm going to do it, and then in the end, it doesn't get done. At the end of the semester, I'm sure you guys are having the same experience. Like, there's so many things to be done, and I don't want to make promises I can't keep. That's probably the biggest issue right now. All right. So that's current ratio and the quick ratio. So the receivables turnover is the next, let me just see what's happening here. Okay. Is the next ratio. So receivables, accounts receivable. That's what we're referring to. And with accounts receivable, we're saying, hey, how quickly are you collecting your accounts receivable? Because if you are selling to people on account, but you're actually not collecting, those amounts quickly, then you're going to have a problem with your cash. Remember, we just did the cash flow, and we know that if we don't collect our accounts receivable, then we end up not having enough cash in our operating activities. So this ratio tells us the number of times on average the company collects receivables during the period. So we're saying for the average net receivables that you have, how quickly are you collecting them? And the way the formula goes is it's the ratio is called receivables turnover, and it's net credit sales. So net sales is sales, you see it over here, rotated sales minus any sales returns and allowances and minus any sales discounts. Again, net sales is sales minus any sales returns and allowances minus any sales discounts. A lot of the times the questions will just tell you the net sales number, but if for some reason they give you a sales number and the sales returns and allowances and sales discounts, you have to subtract those two items from the sales number to get to net sales. Credit means that it's sales on account. Okay, because if you're doing stuff to do with accounts receivable, you're not going to use cash sales in the formula. It's just sales on account. And then average net receivables. Net receivables means receivables minus the allowance for doubtful accounts. These things might sound foreign to you, but net sales came up in accounting 1 in chapter 5. When you were doing a multi-step income statement, you dealt with sales returns and allowances and sales discounts. And the net receivables would have come up in chapter 9, where you did allowance for doubtful accounts, okay? So when I'm saying this, I have to say it with some expectation that you may have been exposed to these things before. Even if you can't remember, it's okay. I will show you how to work with it if we get it in the question. But these are concepts that, would have shown up at some point in accounting. I know most people say they don't remember anything, and that's fine. I just wanted to give you an idea of, I guess, to situate you that these are things that came up in previous chapters. That's why the book in this chapter is not going to go in depth into what these things mean, like allowance for doubtful accounts. It's old information from chapter 9. Average, right, and I'm explaining this because I need to be sure that you know how to use the formula. Okay, so it's a little bit boring because I'm going like item by item and telling you what it means, but it's so that you know how to calculate this thing. Average for any of these ratios, when we have an average, it's telling us that you have to take the beginning number plus the ending number divided by 2. All right, that's in general. Average is going to mean beginning plus ending divided by 2. So for receivables turnover, you're looking for net credit sales divided by average net receivables. If the question is silent about whether the sales are credit or not, then you have to assume that it's credit sales, okay? And if the question is silent about, net receivables just versus accounts receivable, it's okay if it doesn't give you a doubtful accounts amount, then you just use the receivables number. And again, we will do examples. Does anybody have questions up to now? I'm going to give you like 30 seconds just to get your bearings, because I know I'm saying a lot of stuff. I don't want to leave you behind. So take a minute to just think about this. Yes, so many formulas. So that's why, when you guys are doing the test, or even if you're doing it in class with me, I don't expect you to memorize them. The point of this chapter is not memorizing formulas. It's knowing which numbers actually are used in the formula and what the formula is telling you. All right. So I'm going over the formulas step by step to make sure that people understand the components of the formula. But when we start doing examples, you'll see we're using the formula, but the biggest point of doing that is actually to explain what it means, for the company, as opposed to just, yes, I know how to. No, that's what I was saying. I don't require people to memorize these formulas. I think that's an exercise in futility, because if you were working in real life, you wouldn't have to memorize any formulas. You would just use the formulas that are made available to you already. So no, I would give you a formula sheet, but you have to know how to use the formula. Okay, so same thing here. When you do the exam, the final exam, or when you do the homework, just sit with a formula sheet. The book does this. I'll show you guys what the book does. See here, the book gives you the formulas by category. So here's all the liquidity ratio formulas. We've done current ratio and accounts receivable turnover. For some reason, they don't have the quick ratio here, but they should. And then we'll still do collection period and the two inventory ratios. So the book kind of also has the formulas listed. So however you want to have it, either you have these notes from me or you have the book, or both, but you can have the formulas on hand when you're doing your homework and when you're doing the test. All right, so moving on from receivables turnover, we get to the average collection period for receivables. So this is going to be expressed in a number of days. Basically, what it's saying is how many days does it take you to collect your accounts receivable, right? And normally companies give terms, like they'll say you have to do or not do, but you have to pay within 30 days or 45 days or whatever, right? Normally they give their customers terms, otherwise we know they're going to see their money. So what this ratio does here is tells us how many days it's actually taking to collect the money. So it's 365 divided by the number we just calculate above here, receivables turnover. That will give us a number of days, and that tells us, so the company can compare the number of days they're actually taking to collect the receivables versus the number of days that they gave the customers to pay. And let's say you gave your customers 45 days to pay, but on average, you're collecting your receivables in 50 days or 60 days. That's a problem, right? And you're going to have to think about strategically, what are you going to do to get people to pay faster? Maybe you have to employ someone to call everybody, or maybe you have to give a discount for people who pay early, or whatever the case may be. That's the type of useful information that these ratios give you to be able to manage your business better. Remember, cash is king, right? So if people are not collecting their receivables, it means that they're doing business, but they're actually not seeing the cash that they need to see, that they need for paying their employees and paying their bills. So, important information. Then we've got two more to go under liquidity before we do some examples. So inventory turnover, see same name like accounts receivable turnover. It's telling you basically how many times the inventory is sold, the average inventory is sold during the period. So how liquid is the inventory? And we want, sorry, I forgot to say this for accounts receivable, you want this number to be as high as possible, okay? It needs to be as high as possible because you want your inventory to be sold, very often, because converting inventory through a sale means you are getting revenue, right? So the way the formula runs is you use cost of goods sold divided by average inventory. And remember, I told you that average is always calculated in these things as beginning plus ending divided by 2. So cost of goods sold divided by average inventory will tell you how many times you sold your average inventory during the year. And you want the number to be as high as possible. And then I don't know why my formatting is so off here. Who knows what's going on? So the days in inventory, just like the days in receivables, is telling you now how many days it takes you to sell your inventory. So in other words, how long is the inventory sitting on the shelf, right, before it gets sold? So it's 365, again, same idea, divided by the inventory turnover. That tells you, the inventory has been around for X amount of days, so you can get an idea of maybe you're not carrying the right types of inventory that people want, or maybe the inventory is selling much faster than you anticipated and you should buy more of a particular type of inventory, and so on. All right, so those are the liquidity ratios. Let me give you a few seconds to just ponder on that and ask me any questions before we go ahead and do example 1. Okay. So let's move into the examples. So this is example 1. Hopefully everybody has these questions. I think this question is from the textbook, but I can't remember the question number. If you do have the textbook, you may do a control find and find the question yourself if you like. All right, so Lendell Company has these comparative balance sheet data. So comparative, right? 1 year compared to another year. So 2021 versus 2022. You can see here, these first 3 items are current assets, right? Cash, accounts receivable, there's the net. That means that the allowance for doubtful accounts has been subtracted. And this is the net number. Inventory is also a current asset. Plant assets is not net, okay? This is the, equipment, machinery, whatever, buildings, minus accumulated depreciation. This is supposed to have, I lost some formatting here. This is supposed to have a total line, on the top and on the bottom. So I'll just put it there so that it's, when we're reading it, it becomes more obvious. Accounts payable is a current liability, but bonds payable is a long-term liability. Common stock is equity, and retained earnings is also equity. I'm mentioning this because we're going to be doing, some of these liquidity calculations. And in order to do that, we have to make sure that we know which numbers are going to be part of the calculation. Here's some additional information for 2022. Net income was 25,000. Sales on account were 375,000. Okay, so that's the actual sales, credit sales. But then you've got sales returns and allowances amounted to 25,000. Now, if you remember, I said when we were looking at the formulas, right, that when we are doing receivables turnover, it's net credit sales, and net sales is sales minus sales returns and allowances. There's no sales discounts in this question. So, but we do have to deduct the sales returns and allowances. Cost of goods sold was 198,000. We'll probably need this in the inventory turnover calculation. Net cash provided by operating activities was 48,000. We'll see where that is coming in. Capital expenditures, 25,000. Cash dividends, 10,000. This sounds like a free cash flow calculation will be needed. And the bonds payable are due in 2035. They're saying that because they want to make sure that you understand that the bonds payable are not current, right? They're not due within the next year. Questions on any of this up to here before I start doing formulas?
What's the 320,000 and the 345,000?
That's the total. So this is total assets and this is total liabilities and stockholders' equity.
Okay, and is it the same number for a reason or just?
Oh, because the balance sheet has the balance. It's, you know, it will always be the same number.
Okay.
Yeah, you know, you have to balance in the end. So all the assets are represented by some combination of funding, right? Either liabilities or equity. That's how we fund our assets.
Oh yeah. Sorry.
No, don't apologize. These are, ask the questions. It helps me when people are asking stuff so I can know where you may get stuck. Sorry, just give me a second. I'm having some type of nasal issue. 1 second. Okay, I'm back. All right, so the balance sheet, you know, to C's point, the balance sheet is the balance. So we've got everything in order, yeah. So they're asking us to calculate the following, but just for 2022. So watch out for these things in these questions, sometimes just for 1 year, sometimes it's for 2 years, sometimes it's not the year that you think they're asking for. So please make sure that you aren't, you know, calculating things that you don't need to calculate. Like maybe you start calculating 2021 and find out that you're actually supposed to do 2022. So they're looking for a current ratio, accounts receivable turnover, average collection period, which is for accounts receivable, inventory turnover, days in inventory, and a free cash flow. Okay, so free cash flow is not a formal ratio for liquidity. However, free cash flow is an indicator of liquidity because it's showing how much cash the company has left after it pays for any capital expenditures and dividends. All right, so we're going to hit this for all of these ratios. Are you guys ready? Okay. I'm like the only person who's excited about this, right? I know. Okay. So current ratio. So it's current assets divided by current liabilities. All right. So inconveniently, they have not given us a total current assets in the question. It's a little bit annoying, but we can do the calculation ourselves. Sometimes balance sheets will have a total for current assets, but they don't have it here. So we need to add together the current assets. So it's going to be the 15,000 of cash, 70,000 accounts receivable, and 60,000 of inventory, right? Okay, so I'm adding 15,000 cash, 70,000 accounts receivable. I think it was in that order, right? Yeah, and 60,000 inventory. That's my current assets, 145,000. And then if I'm looking for current liabilities, I only have accounts payable. There's nothing else. So 50,000 is the denominator in this ratio. 50,000 is the current liabilities. So now we're just doing a simple calculation like that. So it's 2.9 is the answer, right? But the way we express it is 2.9 to 1. 2.9 to 1. So what does that mean? For every dollar of current liabilities, the company has $2.90 of current assets to pay that debt. That's now the question did not ask you to explain what this means. This is just my personal opinion, but I think it's in some of these questions, it's a little bit of a downfall of the book. It hardly ever asks you to explain what's going on. I also understand that some of that's just because they have the computer, grading. But for everyone that we calculate, I'm going to tell you what it means because it helps you when you do have to explain what it means. It's going to help to know, what the purpose of the calculation is. Does anybody have questions on the current ratio?
So for the current assets, is always going to be cash, account receivable, and inventory, or do we have a different titles?
Yeah, thanks for asking that. There are many, many possibilities of what could be current assets. Your classic ones are cash, accounts receivable, and inventory, but other ones could also be prepaid expenses. They could be short-term investments. I mean, there's no, how can I put this? There's no definitive list that exists of things that could be current assets. You have to look for things that you know. And so, I mean, I'll write it here, right? So cash, accounts receivable, you obviously anticipate that. You anticipate inventory. You maybe anticipate prepaid expenses. I don't know. You might, and remember this from accounting one, supplies. I mean, this is like old school stuff, supplies. And then you get things that are termed like things that wherever there's a word like short-term investments or something like that, these are all going to be things that are current. Okay. The hope is, that a question will give you a total for current assets, but that's not always the case. So you just have to be very careful. Property, buildings, land, those things are never part of current assets. Okay, they're part of property, plant, and equipment, which by definition is long-term. Does that help, Scarlett?
Yes.
Okay, all right.
Thank you.
Sorry, what? No problem. Do they give us the numbers for current? Natasha, it depends on the question. You're asking if they give the numbers for current assets and current liabilities. It's entirely possible that you may have to calculate it just like I calculated it over here. It just depends on how the question is structured. Let me see if there's a question where they do give it. Yeah, like I'll show you an example too. I mean, we're not done here yet, but I'll just show you. It's almost like with the cash flow where the information can be presented in all different ways. Look at example 2. There's your total current assets, right? And your total current liability. So you can just use that number if you have to do a current ratio. But that's not always, it's not always given that way. I hope that answers your question, Natasha. And all right. So and John, I'm acknowledging your arrival. You contacted me on the chat as well. Okay, so current ratio, that's the answer for the current ratio. Let's move on to the accounts receivable turnover. Just 1 second. All right. So accounts receivable. I'll fix the E there in a second. So just like I said before, you don't have to memorize these. You can just go back in the notes or go in the book or whatever. My purpose here is not for you to come out memorized formulas that you're like, oh yeah, you know, I know what this formula is, but you have no idea how to use it or what the answer is actually telling you. That's pointless. We want to be able to know how to put the numbers into the formula and what the answer is telling us. So for receivables turnover, you're talking about net credit sales divided by average net receivables, right? That's what I'm going to say. A net credit sales divided by average net receivables. And the word net always implies that something was subtracted. So now let's go look and see what the question tells us. And this is a little bit tedious, I know, because we're going back and forth here, but it's easier to just have all the information in one place. All right. So net credit sales. So sales on account is credit sales. All right. So sales on account were 375,000, but there were sales returns and allowances, which we need to subtract to get to net sales. Okay. So that's what we're going to do here for the numerator. So it's going to be 375,000 minus the 25,000 of the returns and allowances. Okay. So for some unknown reason, you know, the net income in this question is also 25,000, but don't get confused. I'm not subtracting net income. I'm deducting, I should actually just write sales, returns, and allowances, you know, just to muddy the waters further. We've got a net income number of 25,000 as well, but I'm not concerned with that. I'm looking at this, okay? And then average net receivables, we already know that this is net receivables. We have to average these two numbers, the 70,000 and the 60,000. So I'll just make a thing over here that says, or maybe to the side, what is the average net receivables? So it's going to be 70,000, right, plus 60,000 divided by 2. That's how we calculate it, and that's obviously 65,000, right? It's half of 130,000. So the denominator 65,000 calculated below there. And so you're gonna go that divided by that. So this is the number we will, seemingly the book is doing rounding to 1 decimal. You have to follow whatever they tell you in the question. It might be 1 or 2 decimals. I normally keep 2 decimals. So it says 5.38. So no one really knows what that means. That's nice, right? So the way we express this is times 5.38 times. So I'll write here for you what this means, right? The company collects its average receivables balance 5.38 times per year. That's how we express that. It's somewhat useful, not as useful as the collection period, which I think we're doing next. But it's just telling you that the 65,000, right? They're collecting it, they're selling stuff to the value of 350,000. And then based on the accounts receivable balance that's left over at the end of the year, they must have collected their sales already 5.38 times. If they had not collected their sales at all, then accounts receivable would be 350,000. If they collected all of their receivables, then accounts receivable would be 0, right? But since accounts receivable is 65,000, it's telling us in relation to 350,000 of sales, because we only have 65,000 left, it must mean that we have collected a whole lot of receivables during the year, specifically 5.38 times the average balance. Questions, anybody? Okay, so I'll move on to the average collect. I'm just going by the question, right? The question is just asking one thing after another. So I'm going by that. It's now this average collection period is the next part. So the average collection period, I know what the formula is already, and you see it in the notes. It's 365, and that's because that's the number of days in the year. And we're trying to see how many days it takes to collect our receivables. So you say 365 divided by the receivables turnover. And the receivables turnover is the number that we just calculated over here. All right. So 365 divided by 5.38. That's what we're gonna do. So that's the answer. So the question is now, what does that mean? I probably should follow what the book does, because the book does one decimal, because I'm seeing I'm gonna be slightly different to my answers. Let me do one decimal. For some reason, the book is doing one decimal. I would normally do two, but I don't want to confuse you guys. So let's do 365 divided by 5.4. Sorry if you wrote in pen and now you're like, I gotta change all my answers. I just want to be the same as the book, okay? So that is 67.6 days, which is really 68 days, right? Because I mean, a 0.6 of a day is getting you into the next day. So it's 68 days that it takes the company to collect the receivables. Company takes approximately 68 days to collect its receivables. So now the question is, that good, bad? Right? That good or bad, we don't know. It depends on what terms they gave to the customers. If the terms were, for example, 45 days, then the company is taking way too long, right, to collect. So they need to improve their situation. 68 days is a long time for accounts receivable collection, especially if it's just like a regular business. You know, that's over 2 months of waiting for your money. So if this came up, right, for us, if we, you know, if this was our business, we'd probably have to stop and say, whoa, you know, how can we improve our situation so that we are not waiting so long for people to pay? And often it will be things like, and you guys have probably seen this in your experience, like they'll start charging interest, or there'll be a penalty of some sort because you're late. Or, you know, the other way is to give a discount for people who pay early. But managing accounts receivables is important because there's cash, right, behind that number. Whatever's not being collected is cash that's just sitting in somebody else's pocket and not in yours. Questions, anybody? All right, so I'm going to do inventory turnover. I don't have any questions, so I'll assume we're okay for now. Let's go back up and see what was the formula for inventory turnover. Cost of goods sold divided by average inventory. All right, so we got to find these numbers. What was cost of goods sold? 198,000, and then we have to average out our inventory numbers. So cost of goods sold divided by average inventory. That's the formula. Oops. So cost of goods sold 188,000. Average inventory we're gonna do on the side here again. Remember, average is beginning plus ending divided by 2. And so the beginning is 50, the ending is 60, and you're gonna divide that by 2. So 50,000 plus 60,000 divided by 2. So the answer here is 55,000, right? So we'll put that same 55,000, sorry, 55,000 as the denominator. This is a little bit too close, yeah. You know, like it could be confusing. So 198,000 divided by 55,000, 3.6. And again, the turnover is written as times, 3.6 times. So what does that mean, right? The company sells its average inventory approximately 3.6 times per year. So again, the turnover is a little bit confusing to understand. Think of it this way. If there was a warehouse that contained inventory and the total amount of inventory that could fit in the warehouse was $55,000 worth of inventory. The company is selling 1, 2, 3, and basically a half of those warehouses during the year. Okay, that's what this means. That if we filled up the warehouse once, everything is sold, twice, everything is sold, 3 times, everything is sold, and on the last fill up, we're selling about 60% of the warehouse. That's what a 3.6 times turnover means for selling average inventory. Questions, anybody? All right, so days in inventory is the next part of the requirement. It's asking us to calculate days in inventory, right? So days in inventory, same like the collection period, it's just 365, but divided by the, okay, what's going on here? It's just 365, but divided by the inventory turnover. I don't know what I just did, but I lost my heading. Okay, so it's gonna be 365 divided by inventory turnover. So we've already calculated the inventory turnover above, right? So it's gonna be 365 divided by 3.6. I'll round to 1 decimal since the book is doing that. So it's 101.4 days. The stuff is sitting on the shelf for a long time, all right? So what we're saying is the inventory is on the shelf for approximately 102. I'm rounding up because 101.4. 102 days. You can't round down in with these days because it's saying it actually takes 101.4 days. So I'm going to the next day before it is sold. So is that good or bad? Depends on what it is. If it's a tub of yogurt, that's bad, right? No one wants to eat a tub of yogurt that's 101 days old. If it's a diamond ring, right? It may be normal. So if the company has a lot of different types of inventory, they may want to do this calculation by inventory category as opposed to a total calculation, right? So let's say you are Walmart or Target. They have some types of inventory that, just by the nature of the inventory is going to sit on the shelf much longer than others. Perishable items are not going to sit in the fridge for 101 days. The bag of salad or whatever is going to go bad. But there may be other types of things that are going to be there for a while. So this is an overall calculation of days in inventory, but I bet if you were the manager of inventory at Target, you would probably say, that's great, 101.4 days, that's nice information, but it doesn't really help me to know how I should manage my inventory better. I need to know which items are really causing this number of days to be so high. And those are the items that I probably need to discontinue. I'm sure all of us have at some point gone into a store looking for, our favorite product of something that we like to eat or we like to use, only to be told by the store, like a C-Town or Key Food or whatever in your area, that they no longer carry that item. And you're like, what? Right? I should have bought all of the stuff before they let it go, but you didn't know. And often the reason they discontinue, besides the fact that the manufacturer may stop manufacturing it, often they discontinue the stuff because it's just taking up shelf space, but not selling. And shelf space is like gold for a retailer. So they're not going to keep stuff on the shelf that's not moving. I have this problem often because a lot of the products that I like to eat are British products that are not that popular with everybody. So sometimes I see that there's like a international aisle in a supermarket and I'm like, oh yes, this was especially where we lived before. This is great. I can get all my British products. And then after a while, I've seen this at C-Town, they start disappearing. Certain things are not coming back. And I've asked before, like, what's happening? And they're like, sorry, I guess they don't say this to me, but I think they look at me with sad eyes and it's like, you were the only person buying the stuff. So we can't keep it on for just one person. So that's then the end of the thing. So so same, I'm sure, for stuff that you guys like, what someone telling me, your mozzarella cheese is gone. See, this is your Israeli, and that's what I mean. Like, if you're the only person looking for this, or not, you're maybe not the only person, but I mean, there's very few people looking for these things. The company will try out the product, and if enough people don't buy it, then they're just they're just not gonna put it back. Sometimes I've gone, I mean, I can be pretty ridiculous. I'll go into the store and I'll just buy the whole group of whatever it is that I like to make it seem like a lot of people want this thing, but meanwhile it's just me, in the hopes that they won't discontinue it. I'm sure you guys all have. This has happened to me with perfumes also. Like, suddenly the perfume that I love is no longer at Sephora, etc. Yeah, I'm telling you all my secrets and people are laughing. It's funny because you come out with your sad face, right? Super sad face. My makeup brand or whatever stopped producing something. Now what am I going to do? I should have ordered all that stuff if I had known, right? So the holidays are coming up. Hopefully you can find the Israeli mozzarella cheese. There's that amazing store. Now I'm getting completely off topic, but just, side note, there's an amazing store, which you probably already know. It's close to Baruch College in the 20s on, I think is it Park or Lexington? I think it's Palestinians. They have a range of cheeses, including feta, which I love. That might be a place where you could find your mozzarella, or the people who are looking for other cheeses, right? We can talk about cheese during the break. So let me finish here so I can send you on break and not make everybody hungry in the process. So free cash flow, we already know this from before, but this is from chapter 17. So, you know, I don't want you to panic now that you don't remember what the formula was. Net cash provided by operating activities minus capital expenditures minus dividends. Okay, that's the free cash flow formula. So let's see if we can find these numbers in the question. So net cash provided by operating activities, 48,000, capital expenditures, 25,000, dividends paid, 10,000. So we see all of them. All right. So there's 48,000 minus 25,000 minus 10,000. So the cash that is available to be used after all the payments are made for assets that need to keep the business operating at the same level that it has before, minus any dividends, we've got $13,000 left. So that was all about liquidity. All right, that's the example on liquidity. I've got 11:37 here on my clock, so let's come back at 11:47 and we'll continue and look at some profitability ratios at that point. And then I'm going to go through, you know, liquidity, profitability, and solvency, and after that we can just do examples once we've actually looked at all the ratios. Okay, so enjoy your break. I'll stick around here during the break if anybody has questions for me. Maybe questions about mozzarella. Have a good break.
Oh, seriously, I don't like, they don't have mozzarella cheese here. They only have the shredded one. They don't have the like slices. And I really like making toast with
the
with
mozzarella on
cheese
top.
and ketchup, and it's gone.
Have you been to man, I
I
don't
mean,
know.
yeah, Israeli. I live in the Upper East Side, so
Oh, so you know.
big
I
Jewish
can't remember how to
community.
how
I'm just
to
lazy and I like to go to the there is the West Side supermarket right
okay,
next
so
to my
you
house.
know. This is the shop I was talking about, Kalustayans. It's close to Baruch. It's in the 20s, I think, on Lexington or something. They have like all these things, including, I mean, there's teas galore, but there's also like a whole area of cheese. But it sounds like you already have a spot where you get your stuff. So I
I
don't
mean,
want to cause
there
any.
are some Israeli supermarkets around. It's just like 20 minutes walk from me, 15 minutes.
Oh, okay.
I'm just being
Okay.
lazy, honestly.
Yeah, I mean, I get it. And plus
My house
it's
is-
getting cold now and whatnot. So
Yeah.
Charlotte lipsticks are gone. Exactly. That's the point. Shafak is talking about lipsticks that are gone. That's it. Like, you know, these people weigh up the cost of producing the stuff versus who's actually buying it, what's their margins and so on. And they just decide to stop making them. Well, I'm glad you can still find your stuff somewhere. See, it sounds like there are places. It's just that you maybe are not in the mood to walk there at this point.
Yeah. Eventually I will.
Okay. Right, so we're back from break. I just want to make sure because I was doing attendance earlier and trying to just wrap it up now. Is Michelle here? I don't see her, but I want to make sure that I'm not missing her. Michelle Cameron. Right. And Maria Rios and Tanisa. Are you here? Okay. Everybody else, I have your attendance, all right? So don't worry about the fact that your name hasn't been called out. I've already got your attendance. Okay. So I'm going back up to talk about profitability ratios. Like I said, I'll talk about some ratios, go through an example, talk about the next lot of ratios, go through an example and so on until we get through all the material. And then with time we have left, probably next class, we'll do more examples. I just want to make sure that we don't spend so much time doing the examples on one type of ratios that we end up not being able to actually get through the material because you guys need to be able to do the homework and so on. So profitability ratios measure the income or operating success of a company for a given period of time. We already spoke about that, right? So how profitable is the company? A lack of income affects the company's ability to obtain debt and equity financing. You're not going to invest, or you would be reluctant to invest in a company that is not profitable. You may remember, I don't know if you remember things that I said long ago, but when I was saying that I was looking at the information for the IPO of Sweet Green, and I said to you guys that I was like looking at the IPO price was $28 or something. I'm like, maybe I'll see. I like the product. They seem to have a good business model. But then I went and looked at their financials and I saw that they were making losses. They didn't have net income, they had net loss. And then I was like, I don't know how I feel about this. Maybe they'll do better in the future, but I'm not willing to risk my money because I don't think I've done enough background research. So this is what this is talking about, right? A lack of income affects the company's ability to obtain equity finance. Now, my money is not like, a big deal to Sweet Green. I'm sure there are other people that put money in and everybody believes in it and the stock price will probably rise and that's fine. But for me personally, I wasn't ready to risk the money based on the fact that the company was not looking that profitable. And when a company is not making profits, it also affects their liquidity because it means that even if they are collecting money from their customers, the expenses are probably bigger than their revenue. So the cash going out to pay their bills is more than the cash coming in from the business that they're making. And you can't really grow either, right? You can't really grow your business if you are not making profits, because how are you going to get funding without showing that there's at least some profitability? Or you could initially get funding, but then after a while, the people who fund you may ask for their money back. So a bank, could say, if you don't meet certain requirements, then you need to pay us back. So that's why profitability is important. It has an impact on a lot of things. So some of the ratios that we will look at, this is a very, very important, like classic ratio for profitability, profit margin, right? A measure of the percentage of each dollar of sales that actually results in net income. So, sales is right at the beginning of the income statement, and then you do all the subtractions, cost of goods sold, operating expenses, you take away all these things to come to net income. So we want to say, okay, you might have a great sales number, but are you actually converting those sales into net income, or are your expenses so out of control that even though you have a lot of sales, you actually don't have net income? And we want this percentage that we get at the end to be as high as possible, right? We want this number to be high. We want a lot of net income for the sales that we make, right? So that's profit margin. Again, a very important ratio. Feel free to interrupt me if you guys have questions. The next ratio that we look at is asset turnover. how efficiently a company uses its assets to generate sales. So obviously companies have to invest in some types of assets to be able to make whatever product they need to make and make sales. And so what this ratio really tells us is, how smart were you in terms of the assets that you are invested in, because are you actually generating sales from them? So it shows the dollar of sales produced by each dollar invested in assets, right? So we always want to make sure that if we're giving money to a company, like let's say they are going to invest in assets, that they're investing in good assets that are efficient, that are, actually the types of assets that are needed in the business and so on and so forth. You don't want to invest in a restaurant and come to the restaurant and find out that there's like, excess stoves or fridges or things that aren't even being used, but there was money that was put into it. Those items are not helping to generate sales, right? So that's asset turnover. It's also showing how, how much money are you generating off of the assets that you invested in. Return on assets, it's similar, so watch out for this. Turnover is sales, right? The net sales. We already spoke about what net sales is. Sales minus returns and allowances and minus discounts. Return on assets. As soon as you see the word return, it's going to be some percentage that someone's getting, right? So it's going to be expressed as a percentage. Return on assets is not sales, but net income divided by average total assets. Both have the same average total assets as the denominator, but the numerator is different. So watch out for that. And what does this mean? How much net income is generated by the company's assets, right? Again, if I was a bank and I was looking at your financial statements, I would want to make sure that if you're coming to tell me that you need to, buy another asset, and that's why you need me to loan you money, I want to make sure that the assets that you already have are helping you to generate a lot of sales and a lot of income. Questions up to there, 5, 6, and 7? Before I go on, any questions? Okay. So return on common stockholders' equity measures profitability from the common stockholders' viewpoint. So this is how many dollars of net income did the company earn for every dollar invested in stock by the owners. That's a very important calculation. If you are deciding to put some money into a company, you want to know, hey, what am I getting out, right? Or what, the amount of money that's attributable to the stockholders. What are we getting out for the average amount that we put in? Again, average is going to mean the beginning balance plus the ending balance divided by 2. And I'll show you how to do that. So if we have a preferred stock, remember, this is just for the common stockholders, right? Be careful with this. If there is preferred stock, the net income is not going to be, the entire net income is not going to belong to common stockholders if there's preferred stockholders, because preferred stockholders have a preferred dividend, right? That is, that especially if it's cumulative, that's going to go to them. So the way we then calculate the ratio is that we have to subtract any preferred dividends from net income. And the question will give you this information. It will tell you if there's preferred stockholders and what the preferred dividend is. Because what we're saying is we only want to see the amount of money that belongs to the common stockholders. And so we have to subtract, right, any preferred dividends from that, because it's not going to go to the common stockholders. And we don't do this calculation for preferred stockholders, because remember, their dividend is a set percentage. We did that in chapter 14. Their dividend is a set percentage. That's their return. They don't have, rights to any additional returns like the common stockholders do. The common stockholders have a residual interest. So everything that's left over after we pay the preferred stockholders is attributable to common stockholders. Again, we follow the formula. Because this is a return, you'll see when we do the calculation that it's going to be expressed as a percentage. Any questions there? I'll continue here with earnings per share. And again, don't worry, I'm going to do I think it's 2 examples when we're done going through all of this that will show you how to calculate each of these numbers. Earnings per share, very popular number in finance and in accounting, because this basically tells you what each share, common stock, right, what each share earned in terms of the income that is attributable to it. So it's a measure of net income earned on each share of common stock. So it gives you again an indication of profitability. This is often a number that is what do you call it, that is forecast by analysts. Like analysts will say that we expect, you know, whoever, we expect Apple to have an EPS of $6 per share. And then, you know, the company will try as much as possible to meet or exceed those expectations, because if they miss the earnings expectation, usually what happens? The stock price falls, right? They miss revenue and earnings expectations. Normally the impact is on the stock price. So, and a lot of, I mean, there's like an ethical issue here also, because a lot of the big people, the top people in the company have, you know, they have a lot of investment in the stock of the company. So they have an incentive to make sure that they meet these earnings forecasts that the financial analysts give, so that their stocks will still be worth a lot of money. But, you know, so there's a conflict, a little bit of a conflict, because you want to make sure that the earnings numbers that, you know, are given are the real numbers, and not numbers that have been massaged, for lack of a better word, to be in line with what was expected. So, you know, when you think about accounting at a big firm like a, you know, publicly traded company, you have to think about what incentivizes the management. And sometimes, you know, there is somewhat of an ethical dilemma, because management gets part of their pay sometimes in stock options, which means the increase in the stock price is to their benefit. But they should also be accounting for things, you know, they're accounting on the books in a way that is truly showing the true picture of how the company is doing. And sometimes those two things don't always go together, right? I'm not saying anyone's committing fraud. I'm just saying that there's an ethical dilemma to make sure that you're doing the right thing, when you know that sometimes the right thing could cause the stock price to go down. So earnings per share is calculated as net income minus the preferred dividend. Again, the preferred stock doesn't factor into this. They've got their own return. We're not worried about them. So subtract their dividend, and then divided by the weighted average common shares outstanding. So again, you average is beginning plus ending divided by 2. Sometimes you're just given the average, the weighted average. When you get to, you know, further accounting classes, there are a number of you who are accounting majors in this class. You actually sometimes have to calculate the weighted average. That's based on when in the year the shares were issued. But for our purposes, you don't have to do that. You're just doing a simple average, beginning plus ending divided by 2, and that's enough. In computing EPS, if there are preferred dividends declared for the period, like I said, we must deduct them from net income to determine income available for common stockholders. I'll let you simmer on that for a second. Make sure you don't have any questions for me before we move to the next thing. All right. So we've got 2 more profitability ratios before we start doing another example. The PE, or price earnings ratio, I'll show you. Let me see if I can find it. Let's go with Apple stock. There should be a PE ratio. What did I just do? Okay. Yeah. You see this PE ratio 28.91. That's the price earnings ratio. That's what we're talking about when we are looking at this number. Okay, so Apple is at what, 162 today. The price to earnings ratio is 28.91. So let's see what that actually means. It's a measure of the ratio of the market price of each share of common stock to the earnings per share. So you're taking the price of the, sorry, I'm going on the wrong thing. The price, 162.2 divided by whatever the earnings was. They don't give you the earnings per share here. It would have to come from the annual report, from the financial statements of the company. And so what does that really mean, right? Because it's like, what is going on here? Do we understand what we're looking at? It reflects what the investors think the company's future earnings will be. So they're saying, how much am I willing to pay for $1 of earnings? These investors who invest in Apple are willing to pay $28 or almost $29 now for $1 of Apple's earnings. Does that sound crazy to you? Maybe, right? But why would you do that? Why would you pay so much now for $1 of earnings? What do you expect to happen in the future that would make you say, yes, that's a good deal?
The price will go higher.
Mm-hmm. And you expect a lot of earnings. You expect the price to go up, and the price going up is an indicator of us expecting that the revenue, that the earnings per share and everything is going to be increasing. So we're willing to pay 162 today, even though, I mean, I can actually just back into the number, right? So if it's 162 divided by 28.91, so they made like seemingly $560 or so of earnings per share. We're willing to pay $162 for one share today, knowing that we're probably earning about $5.60 per share in net income. But as Shafak was saying, it's because we expect that the price of the stock is going to go up, and the price of the stock is going to go up because we expect that the profits are going to be going up in future. All right. I don't know what Google's, I feel like Google may have an even higher PE ratio. I could be wrong. I haven't looked at Google stock in a while because I can't afford it. So it's the same, 27. So, we're saying kind of the same thing, that they expect the earnings. They'll pay 27 times now, right, of $1 of earnings, because they expect the price to go up so much.
So, Professor, if I'm getting this right, if we if we divide the current price of a stock with the PE ratio,
you should get back to earnings per share.
So the answer we get is the extra amount of money we pay on each dollar.
No, the extra money you pay on each dollar is 27.48 in this case. Okay.
Oh,
if you say, because you were just saying, what if you take the price and you divide it by this, right? You're going to get back to the earnings per share, because that's the formula.
Also, that's their profit per share. The answer I get.
Earnings, yeah, the earnings per share. Yeah.
Okay.
If you have the PE ratio is the price of the stock divided by the earnings. That gives you 27. If you start with 27 and you have the price, then you can work back to the earnings. Yeah.
Right. Okay. Thank you, Professor.
No problem. So this is the expectation that people have, right? And so 27p is pretty high. It's saying that I'll pay $27 for $1 of earnings because I think the price is going to go so high, right? I don't know. I can't remember who has like an even crazier. Let me see what's happening with Tesla. Who has an even crazier PE ratio? Yeah, here we go. This is what I was thinking. Like, they're crazy, but that's because Tesla has a massive stock price, but a very small earnings per share. Okay, so the PE ratio is going a little bit nuts. You remember Tesla wasn't even profitable a few years back. So so people are really paying. I mean, look at the price, right? $1,100 they're paying on earnings that I'm trying to see here. Their revenue was 31.54 billion, but they don't tell us the net income. Let me see. There's a quarterly financial year. I'm not going to spend too much time because I know we need to move on. But okay, so they have net income 162 billion. But if you go back, I don't know if I can go back a few years, you will see that that things were not that great for a while there, where they weren't even making profits. So I think it's more like in the 2018-19 timeframe. So people are paying a heap of money for Tesla stock, and it's because they basically believe that that the earnings are coming in, and they probably will come, because I mean, electric cars for sure. It's a big deal. You know, I don't have a Tesla. I don't earn enough to own a Tesla, but I do have an electric car. And let me tell you, one, I'm happy that I'm not impacting, you know, the environment as much. But two, it really helps not to have to go to the gas station. So people, I think maybe, you know, now that gas is like $3 and something cents a gallon, or maybe thinking about electric cars as well. Anyway, that's just my 2 cents. So what's going on with price earnings ratio? You're saying how many times are you willing to pay for $1 of earnings, right? And it can be as high as $364. Someone is willing to pay for $1 of Tesla's earnings because the stock price is so high, because they expect future profits. A high PE ratio means that investors anticipate growth for the company. We would normally compare the company to other companies in the same industry or sector. So we looked at Apple and Google. They're kind of, you know, they're not completely in the same industry, because obviously Google doesn't have a lot of the offerings that Apple does have. But they both have PE ratios of about, you know, 27, 28. So it's similar. You know, Tesla as its competitors, but those competitors' share prices are not as high. So the PE ratios are going to be way off. So that's the ratio, market price of the stock divided by the earnings per share. And then the last one here for profitability, before we do our examples, payout ratio. So this is talking about how much of the profit is actually being paid out in dividends, because as much as we like to say that, yeah, this company is so profitable, but then the question becomes, are we actually sharing in those profits, right? So sometimes people also look at something like, if I can go back to the stock price, let me see, a dividend yield. You see there's nothing here. Dividend yield means, did they pay a dividend, and how much are you yielding back? How much are you getting back? Zero. That means no dividend. So no payout. So with the payout ratio, we're looking for cash dividends on common stock, not on preferred stock. This is all just about common stock divided by net income. So we're saying what percentage of your net income was actually paid out as a dividend. And that's all got to do with profitability, right? The more profitable you are, the more net income you have, the more retained earnings you have, the more likely that there will be a dividend that will be paid out, and so on. So as a potential investor, now I'm not saying that you are going to go and do all these calculations, you know, for all the big companies and so on. There are other people who could do this for you if you're willing to pay for subscriptions to things like Morningstar or Motley Fool or whatever. But the point is, a lot of these analysts do, you know, do maybe not all of these ratios, but some of them, to say whether an investment, and it's called fundamental analysis. So you're looking at the fundamentals of the company using the financial statements to try and determine whether the stock is over or underpriced, and whether it might make, I mean, if it's underpriced, then you want to get in because it might make a good investment, right? So, and the other, if you don't do fundamental analysis, there's another type of analysis that you can do. It's called technical analysis. And that's when you look at charts and graphs, when you look at the changes in the stock price. So that's very different from what we do with the financial statement analysis. All right, so those are the profitability ratios. Any questions for me before we dig into, I believe it's going to be example 5. That is the one that gets us going on profitability ratios. Anybody? Questions? Okay. So let's look at example 5 quickly and see how far we can get here. Yeah, so I mean, I guess what I just want to say is I hope it's becoming more obvious to you guys that this, this exercise that we're undertaking in chapter 18 has got a lot of intersections between accounting and finance, and it's useful, whether it's finance for debt financing companies, banks look at these ratios as well, or for equity financing where people are thinking about giving you money and getting stocks in return. These are all, very widely used types of analyses. All right. So example 5, selected hypothetical, comparative statement data for the giant bookseller Barnes and Noble are presented here. All balance sheet data are as of the end of the fiscal year, and they are in millions. So often when you look at financial statements, the numbers are in millions or in thousands. So when you look at this, right, it's in millions. So that means that it's 9. It's going to be 9 digits after the main one. So it's actually billion, right? So the net sales is 5.1 billion. I'm not sure how they would know in 2022 what the what the sales are. It's probably just made up numbers, but nevertheless, these are billions, and they're giving you net sales, they're giving you cost of goods sold, net income, net accounts receivable, and inventory number. They're telling you what's total assets and total common stockholders equity for these 2 years. And so what we have to do is go through and calculate all these profitability ratios. The gross profit rate, we didn't go over that formula, but the gross profit rate was calculated in a previous chapter, but I'll go over the formula with you now. It doesn't, the formula doesn't get shown again in chapter 18, but it's because it's supposedly, it from, I think it's chapter 5, but I know already people are going to say they don't remember it, so that's fine. So exercise 5 or example 5. Exercise 5. So profit margin is the first item. So this is what I mean. If you can't remember the formulas, right, you just have them next to you, either from this handout or from the textbook, it doesn't matter, but have them handy. You don't want to be running around looking for formulas when you're busy with the exam. Net income divided by net sales, right? Oops. So here's our net income number. They're asking for 2022. I guess the only reason they're giving 2021 numbers is because there's some averages that we would have to calculate. So be careful with this, okay? You don't want to just start doing calculations and not knowing which year you're doing them for. Sometimes you have to do them for 2 years, and you have to be aware of that as well. So 2022 profit margin, so it's net income 75.9 divided by net sales. Since all the numbers are in millions, you don't have to add zeros onto anything. You can just use the actual number. So it's 75.9, and you're going to divide that by this net sales 5121.8. This doesn't look so good. Yeah, it's pretty bad. So that's what comes out, and you're like, huh? What does that mean, right? So profit margin has to be, this has to be expressed as a percentage, all right? So it's looking a little bit weird now. So we're going to make it into a percentage. You can multiply by 100, or you can just, if you're doing it in Excel, you can obviously do that. And this book is doing 1 decimal again. So 1.5%. So what does that mean, right? For every dollar of sales that Barnes and Noble makes, it has 1.5 cents of net income. That's what it means. So this was for 2022, right? Now for interest sake, even though this is not asked in the question, I'm just going to calculate it for 2021 because I think this number looks pretty bad. It looks quite low, right? And I'm just wondering if that's the case, or maybe it's just my own opinion. So if we look at 2021, what was net income in 2021? 135, right? 135.8. So 135.8 and net sales 5286.7. 5286.7. What do you see? What do you guys see here? 2021 versus 2022. What's happening?
The net income is more.
The net income is what?
Is more than
In 2021, right?
yeah.
So things are getting worse. Do you see that? 2021, we had a profit margin of 2.6%. That means for every dollar of sales, there's 2.6 cents of net income. In 2022, that percentage drops to 1.5, right? So that's a big drop. It's like the net income, the sales number, I mean, it changed, but it's the amount by which the sales number changed is nowhere near what happened with net income. Net income basically went down by 50% almost. So yeah, for every dollar of sales, there is 2.6 cents of net income, right? That's what we're seeing. So between 2021 and 2022, Bonds and Noble had a 1.1, oops, what just happened? Sorry about that. 1% decrease in profit margin. So that's not good. That's bad news for them because we want profit margin to be as high as possible. So this decrease is not good. So think about that for a second and tell me if you have any questions. It's not asked for in the question, but I think it's useful for you to see how we can compare the ratios for 1 year versus another, right? And see, remember, this is intra-company, within the company. See if they're doing better, worse, or the same 1 year over another. And in this case, unfortunately, Barnes and Noble is not doing better. They're doing worse. Anybody have questions about that? No? Okay. So that was A. So A was profit margin, or I don't know, I just have bullets next to it, so I'll just make it A and B. So B is going to be asset turnover. I'll go back to the question here in a second. The asset turnover, right? So let's say I don't remember what the formula was. I think it was net sales over average assets, but I have to go check. So just go back up and refresh your memory. Okay, net sales over average total assets. That's our asset turnover formula. So again, you see, I mean, it's a little bit tedious, but you see that you're basically just applying a formula to some numbers and concluding on what that means, right, for the company. So it's net sales over average total assets. That's the formula for asset turnover. So net sales, and I'm still doing this for 2022, 5121.8, same numbers before that we had in the other example. And then average total assets I have to calculate. So total assets. That's going to be the beginning total assets plus the ending divided by 2. So it's going to be these numbers, right? This is the beginning number. This is the ending number divided by 2. So we have 3249.8 plus 2993.9. Divided by 2. And that is, let me see if I have the number here. I don't know what that comes to, so I'll have to do the number. Okay. 3249.8 plus 2993.9 over 2. Okay, so that's the answer, the 3121.85. So notice here that you probably would do well when you're doing the homework and when you're doing the test to write out your calculation on a piece of paper or something and not just do it on the calculator. And, you know, if you just do it on the calculator and it comes out to the wrong answer in Wiley, then maybe you can't remember what you did. Whereas if you write it out, you can kind of check your numbers and see where you may have gone wrong. You can check your numbers against the formula. Okay, so the answer is 1.64 times because it's a turnover number. It's you express it in times. And the way we explain this is for every dollar invested in assets, the company makes $1.64 in net sales. So although it says times, it's basically saying your $1 of assets is multiplied 1.64 times as sales. Okay. But that doesn't feel like it makes a lot of sense. So this is an easier explanation. Questions on asset turnover before we move on to the next thing?
So this was for 2022, right?
2022.
Should we be doing for 2021 too, or just that?
We can't actually because we don't have the ending balance for 2020 to be able to do an average total assets in 2021.
Oh, right. Okay.
So I just did the 2021 for profit margin because I knew I didn't need to average anything out. But I can't really do it for anything else. Maybe gross profit rate. That's the only other one that doesn't have an average. So thanks for asking that. The question only asked for 2022, and we just don't have the extra information to do the same calculation for 2021, because remember, average is the beginning number plus the ending number divided by 2. Other questions? Okay, so we move on to C, which is return on assets. So return on assets. So it's almost the same as asset turnover, except that instead of using net sales, you use net income as the numerator. Okay, and remember return, whenever you hear return, it's a percentage. That answer is going to be expressed as a percentage. So it's net income divided by average total assets. Sorry, there's some spelling mistakes happening here that are not that great. All right, so what is the net income for 2022? We know this number already, 75.9, right? So 75.9. Thankfully, we've already calculated average total assets up here, so we can bring the same number down, right? The 31214. It's the same number. You don't have to recalculate it again. And remember, everybody has access to this document on, the link is on Blackboard. So if you suddenly get stuck with something and you don't know what happened, you can see my work. This looks like chaos, right? What's going on here? This number needs to be expressed as a percentage. So multiply by 100, right? That's how, if you're not doing it on Excel where you can just put the percent sign, the way you do it is to multiply by 100. So you're going to get 2.4%. That's the answer, 2.4%. So what does that mean, right? So don't get confused now. 2.4% is not $2.40, okay? The way this works is for every dollar invested in total assets, the company makes 2.4% of a dollar is 2.4 cents in net income. And so some of these things might feel a little bit like, okay, so what, right? Because the thing is, you don't have the previous year's number to see if they're doing any better or any worse, right, than the prior year. But the purpose right now of what we're doing is really to make sure that you guys know which formula is attached, you know, to which ratio, how to put the numbers into the formula, and what the answer actually means. And then, of course, if you had to do the previous year and the number was higher, then you would say, oh, this number is decreasing, which is not good. Again, we always want these percentages, this return on asset percentage, we want this number to be as high as possible. The only time when we don't want numbers to be as high as possible is when we do like debt to equity. We don't want our debt numbers to be as high as possible, but everything else really, well, debt to equity, and also you don't want your days in inventory and your collection period to be too high. But a lot of these percentages, we want them to be as high as possible. Yes, Shafa.
So Professor, if I am trying to buy a stock from stock market, so the right way to find out if the company is doing well or not is to apply this formula and calculate their earnings per share, or
let me say that it depends on how deep you're going into the analysis, and we have to be careful of saying the right way because there are many ways to do it. Remember I told you about that Warren Buffett book also, you were asking me about it. Analyzing the financial statements is one way of doing it. But when you look at investing a stock, you really want to start on what I call the macro level, meaning what's happening in the economy. How does the company's business relate to, you know, trends in the economy? You know, where do we think the economy is going, and where is that company going in relation to the economy? Then you come to the company itself and you start, and yes, you can, I mean, even if you wanted to invest in a company now, you could pull up their Form 10K, which is their annual report, and you could calculate return on assets, and you could see how the company is doing. But you can also pull some of the stuff up for free on, like, I'm sure you've heard of Reuters or the website investing.com. There's a few websites where you can actually see this analysis was already done by some equity analysts, and you can see some of it for free. But yeah, this is part of what people do if they're doing fundamental analysis, to see how the company is doing. And then the other part, and I don't mean for this to become a finance class, so I'll stop talking in about 30 seconds. The other part is that they also sometimes do forecasted cash flows and discount them back to see what they think the stock is worth. And then that will, or do earnings multiples, and that will determine whether the stock is over or undervalued and whether they'll invest or not. So it's a pretty involved process. It's, you know, a few ratios won't cut it. There's a lot more that goes into it.
Right. Okay.
All
Thank
right.
you.
And when you join the finance club, then I can show you more stuff.
Okay.
All right, then we can talk at length about all of this. All right. Okay, so 2.4%, 2.4 cents per dollar of money invested in assets. Good, bad, ugly, indifferent, we don't know until we compare it to the industry, or we compare the company to itself, or we compare the company to a competitor. This is really just calculating. The finance club is not open yet. I need to basically resurrect the finance club next semester when I'm back on campus, but I'll take your guys' names and contact you for joining the finance club. Okay. You know, I don't want to forget to say this, and since we're on the point of finance, and I will finish this example before we go, but tomorrow's Wednesday, right? Tomorrow at 2:15, I don't know if you guys are getting these emails, but there's another one of these Money Boss investing. There's going to be an investing session at 2:15 with Professor Trapani. And you know, if you want me to send that email to you, just stay on at the end and we can talk about it. But yeah, the Money Boss thing is happening at 2:15. Trapani will be talking about investing. I think they're recording it, so if you can't make it at 2:15, you can listen to it afterwards. The information is on the library website. Okay, so that's return on assets. The next one is return on common stockholders' equity. That's you know, I've explained this formula to you already, but we'll just go back and look at how we calculate it. Right. So return on common stockholders' equity, if there's a preferred dividend, you're saying net income minus the preferred dividend divided by the average common stockholders' equity, right? Not just everybody. You don't include preferred stockholders in this number. Okay, so let's see what we have from the question. So net income, let me see if I can do that and then write it here. Okay, so net income minus preferred dividend divided by the average common stockholders equity. Okay. So we already know the net income number. We've seen it a few times now, right? At 75.9 for 2022. There's no preferred dividend. The question doesn't tell you anything about a preferred dividend. So the average common stockholders equity, we have to calculate that now. So average common stockholders equity, so it's beginning plus ending divided by 2, right? It's the same story. So let's see what the stockholders equity number is. I can't remember. Right. So it's this 921.6 and 1074.7. So 1074.7 plus 921.6 divided by 2. And I don't know how much it comes to, so I have to do the calculation over here. 1074.7 plus 921.6 over 2. So 998.15. So that's going to be the denominator. So it's just put 75.9 because we know that there's no preferred dividend, so this doesn't look so crazy. So another weird number has to be expressed as a percentage because it's a return. So I do that and it's 7.6. So what does that mean? for every dollar invested in common stockholders' equity, the common stockholders earn 7.6 cents in net income. So if you were a common stockholder and investor, right, would compare this return to the returns on other types of investments, right? And to the return for this company in the previous year to see if the return is good or not. Like if I had to say to you, last year we earned 10%, you'd say, whoa, this is too low. And last year could have been better because the net income in the previous year was almost double, right? 2021's net income was 135.8. 2022 is only 75.9. So, you know, what I would do if I was a stockholder at that point, I would go look at the income statement to see what it was that was causing the net income to go so low, you know, this year, to see if that's something that's expected to continue in the future. Because if it is, then maybe I need to take my money out of here. But of course, that depends on what the stock price is, right? You can't just pull your money out regardless of the stock price, because, you know, you invested your money in this company and you need to make sure that you don't just take it out at a loss if you can avoid that. All right. And then, yeah, so I mean, if you had to, let's see where Barnes and Noble is trading at. Well, I don't know why there isn't a graph, but it seems to be $9.44. So, right? Okay, so last one. Gross profit rate. So what's going on there? All right, so the gross profit rate is just going to be the actual gross profit divided by the net sales. That's all. Oops, sorry, gross profit divided by the net sales. So we're saying, you know, what's the profit as a percentage of the sales that we've made? And let's go back to the question, do we have a gross profit number? We do not, right? So we have to remember how to calculate gross profit. So net sales minus cost of goods sold equals gross profit. That's from a multi-step income statement. All right. So you have to kind of dig back to multi-step income statement to remember that gross profit is the answer after you subtract cost of goods sold from net sales. So net sales for 2022 is 5121.8, right? We've seen this number a few times, but 5121.8, the cost of goods sold is 3540.6. So 3540.6. And so the gross profit $1581.2. All right, so there we have the number that we need. So 1581.2 divided by 5121.8. So another weird thing has to be, the rate is also a percentage. It has to be expressed as a percentage, right? So that's what we see. So what does this mean? For every dollar of net sales, the company generates 30.9 cents of gross profit to cover, this is the gross profit covers operating expenses. That's what that means. I mean, if you also just ended the sentence at 30.9 cents of gross profit, that's fine. But I'm just reminding you that gross profit is then used so sales in a multi-step income statement, sales minus cost of goods sold. We also did this in chapter 14, right? Sales minus cost of goods sold is gross profit minus the operating expenses and other stuff is net income, all right? So the gross profit helps us to pay for our operating expenses. And of course, you could do the same calculation for 2021. I won't. Do I want to? I'll try it quickly. You guys, I'll just put it here and we can go over it when we come together. I'm just going to do it quickly for those who do care, which may be only me. That's okay. All right. So these are the numbers for 2021. Right? 1606, right, is your gross profit. So it's going to be close, right? Let's see. So it's 1606 is the gross profit. The net sales is 5286. Almost the same, 30.4. So there's been hardly any change there's hardly any change in gross profit rate between 2021 and 2022. So that means that the problem with this profitability issue is somewhere in the operating expenses, right? Because the company is generating the same amount of gross profit every year, but their net income is like half in 2022 versus 2021. So it must mean that the operating expenses ballooned in 2022. We don't have an operating expense number, so it will forever remain a mystery, right? Okay, we'll pick it up there next time. Thanks for your attention. You're dismissed. Please don't forget to finish the test and the quiz. And I will see you on Thursday and we'll pick it up over here. All right. Bye.